So, you have just stumbled into the world of investing and you came across many foreign terms, from value investing to growth investing to momentum trading and even price action. So many questions, so little answers. So in this video, I'll be sharing with you a simple framework of how I understand investing, and it will probably be a very good start to your investment journey. So let's get into it. So there are a few core pillars in the area of personal finance, from income generation to budgeting to savings to retirement, etc. etc. But in this video, let's focus and dive deeper behind the concept of investments. So investing on a much broader perspective is really this idea around capital management. How do you effectively make your money work much harder for you? So behind this concept of capital management, which is CM for short, there are two core umbrellas. First, you have the trading arm, and the other one is the investing arm. So I'll just briefly run you through the trading arm because that's not the focus of this video. Essentially, there are many modes of how traders look at the market. Some people like to do day trading, some people like to do swing trading, and some even just ride on momentum and just look at several indicators like the moving average, etc. Trading specifically, it requires a lot of monitoring. Traders probably monitor the market on a much closer basis, and they really need to understand the nuances of the market and make very snappy decisions and judgments every single day and even by the minute. Investing, on the other hand, is far more interesting. So that's essentially my focus of this video. So investing, there are subsections. Again, there are two subsections, in fact. First, it's called passive investing, and then the second arm is active investing. So let's try to break down the easier one first. Let's look at passive investing. So another term for passive investing is actually this term called LWOGR. Long story short, lazy way of getting rich. So what most investors do with this passive investing approach is really just buying something called an ETF, or an exchange traded fund in short. So what an ETF essentially mimics is an underlying index that comprises a whole basket of different stocks. So compared to active investing, where the investor takes an active approach, picking individual stocks, looking at how the company perform, monitoring their quarterly performance, what lazy or passive investors do is to buy into a specific index. And in this particular index, there are a few ways of how you can categorize ETFs. I think the two most popular ways is really either by geography or by industry. So let's first look at industry. So industry meaning, I believe most of you are working, and in your own specific domain, you have companies like in the tech industry, you have companies in the semiconductor industry, you have companies in the fast-moving consumer goods. You have companies like Procter & Gamble, etc. Semiconductor, you have companies like Nvidia, Taiwan Semiconductor, etc. And for your tech companies, you have your Google, Amazon, blah, blah, blah. So in this case, from an industry perspective, what you are doing is you can buy a tech-specific index, or you can even buy a semicon-specific index. On the other hand, you can also seek to look at a geography-based ETF. So example, you have your US-based ETF, your China-based ETF, and for those of you in Singapore, you can even buy the Singapore-based ETF. So SG, usually you look at ETFs like STI, which is the Straits Time Index. China, you can look at the MSCI China. US, people tend to look at the SPY or the QQQ. So as a passive investor, what you're really trying to do is to get something called the MR, which is market returns. You're not in the business of trying to beat the market. You don't want to outperform the index. You just want to make sure that your money basically fights inflation, and to make sure that you have a sizable amount of retirement nest egg when you are bound or when you are ready to retire. So when we focus our attention on this idea behind market returns, there is this so-called gold standard in market returns. Why is there this idea of a gold standard? Simply put, everyone in the finance world basically try to measure their performance against this gold standard. Because, firstly, It's one of the most widely renowned and widely accepted index. It has stood the test of time, and it is in one of the most matured market. And for those of you who know, maybe you want to leave in the comment section. But for those of you who don't, it's essentially the US S&P 500. This ETF, don't belittle it. It has been in the market for at least 200 over years. So the US S&P 500 has offered a 7 to 10% CAGR over the last 50 to 100 years. And that's why it's one of the most widely known index. So some of you might ask, what is the S&P 500? It essentially tracks the top 500 companies in the US. And as you all know, most of the biggest conglomerates out there in the world today, you have companies like McDonald's, Coca-Cola, these are your more traditional companies. You have your tech companies like Amazon, Microsoft, Apple, they're all from the US. You have big semiconductor companies like Nvidia, AMD, they're all from the US as well. So what this index essentially do is to track these top 500 US companies, break them up into smaller pieces, keep it and package them into one very simple and digestible way for you and me, the layman investors, to just spend a few $100s to buy the 500 top companies in the US today. So that's what essentially an index fund does. So some might ask, hey, what if I want only the cream of the crop? So there's another position, rather than the US S&P 500, there's one more in the US as well, which is the NASDAQ. So the NASDAQ, there are ticker symbols like the QQQ, which tracks the NASDAQ, and they, historically, at least over the last 10 years, have returned around a CAGR of 12 to 15%. So specifically for the NASDAQ, it basically tracks around the top 100 companies in the US. Most of it are your tech companies. And they basically kick out all your more traditional companies like Procter & Gamble, etc. So from this perspective, you might think, hey, since I'm young, I just started learning investing, why not? Let's just whack 100% of my capital into the US NASDAQ. I have a very long time horizon, I want a huge amount of capital appreciation, and it seems like at least over the last 10 to 20 years, the NASDAQ has increased by a much more larger extent. But let's not forget this idea of risk reward or risk return. So I think it's relatively true that over the last 10 years, the NASDAQ did outperform the S&P 500. But let's also not forget that during downturns and during bear markets, the NASDAQ tend to be the worst performer compared to the S&P 500 as well. Just to give you a flavor, for the US S&P 500, when it undergoes some sort of a bear market, at least over the last 2 decades or so, during the 2000 tech bubble, during the 08 crisis, during the 2020 COVID crisis, and even the 2022 inflation. So over the past few bear markets, the S&P 500 tend to go down by a factor of around 20 to 40%. The NASDAQ, they can drop 40 to 60%. So this is the idea behind volatility risk. Do you have the ability and the competency to stomach this sort of volatility? Looking at a $100,000 investment, going down 60%, that's $60,000 in a matter of 6 to 12 months. So that's really this idea of risk reward. With greater reward expectations, at least for now, there is a greater amount of risk for you to bear in a case of bad market downturn. So some might ask, hey, why do I want to specifically only focus on the US geography? What happens if the emerging market, for example, recently, the Nifty 50, which is India's stock market index, they have also experienced some sort of a monstrous return. So other than just focusing on a US-based index like the S&P 500 or the NASDAQ, there's another alternative that essentially seeks to track the entire world market return. So let's not be biased against the US, let's not be biased against Singapore or India or whatnot. Let's focus on trying to read the market returns of the entire world. And in this case, if you want to focus on a world ETF, you have companies like Vanguard offering this ticker Vanguard Total. So VT essentially tracks the entire world, but that said, because the US market is still the much more matured ones, even in VT, 60% is in the US, while the other 40% is in the rest of the world, like other developed and emerging market economy. So specifically for VT, when you track the historical performance, its returns are much closer to 4.5 to 7%. So it then begs the question of people wondering, oh, why would anybody bother buying VT? The returns profile is much weaker when compared to QQQ and compared to the S&P 500. So I think first things first, it's true that we acknowledge that the US market has significantly outperformed the rest of the world for the last 10, 15 or even 20 years. But let's not forget, I think as history has shown, there are times where emerging economy stock market actually do outperform the US stock market. It essentially works in cycles. So that's why for people that wants to be really completely market neutral, that's when they will focus on maybe basically getting a world exposure rather than placing emphasis on the US market, Singapore market, Chinese market, etc. And if you look back into history, back in 2020, before the pandemic hit us, Vanguard total from peak to trough was also down around 20%. So I think it's really dependent on you to make the judgment call on how you wish to allocate your capital in a portfolio. Whether you want to allocate a much more higher risk approach, going 100% into Nasdaq, or you want to go completely in the opposite way, going 100% into a world ETF instead. I guess it's really up to personal preference. Now, there are nuances in choosing the right vehicle and instrument to achieve your ideal retirement and to get the necessary returns profile. But that said, I think specifically for passive investing, there are three key areas that you have to focus in. Firstly, it's really money, which is the expense ratio, meaning the amount of fees that you have to pay for the ETF provider, and these fees will essentially eat into your long-term returns. Number two, it's TE. So TE represents tracking error, meaning let's not forget all these ETFs are basically tracking a specific index. Whether it tracks the S&P 500, it tracks the STI, whatever it is, there are certain indexes that do a very poor job in tracking compared to others or relative to other providers. So this is something that you have to keep in mind as well. And last but not least, there's the idea behind taxes. So at least for those based outside of the US, you are subjected to a 30% withholding tax. And for those in Singapore or other parts of the globe having access to the London Stock Exchange, you can look at the other providers like VWRA or CSPX that essentially tracks the same thing like the S&P 500 or a world ETF but with much lesser taxes. So these are the three specific considerations when you look at passive investing. So just a very, very quick recap. Passive investing, the lazy way of getting rich. When you look at ETFs, there are two specific ways you can look at it. Industry-specific ETF that focuses on specific industry, or you look at it from a geographical perspective where you want to invest in the US, China, Singapore, and if you totally want to be neutral and want to achieve the pure market returns, then you can consider a world exposure ETF. So that pretty much sums up the passive investing route. Let's pivot over to active investing. I think the main goal for most investors is really to make much more money. So when people adopt a different strategy, when they look at active investing, it's really just so that they want to beat the index. And like I said, the gold standard here is to beat the S&P 500. So in a long-term track record basis, the S&P 500 has produced right around 7 to 10%. So as far as I know, many active investors tend to set their hurdle rate, or in this case, the rate that they wish to beat, to be between 12 to 15%. So even if they fall short, they would still be in a very comfortable position of beating the S&P 500. So that essentially is active investing. So intuitively, active investing requires a much more active approach. Investors need to spend a little bit more time trying to monitor the market, look at competition, understanding the quarterly reports, understand the management team, etc., etc. Because what you are essentially doing is to pick a portfolio of stocks. Maybe you monitor 8 to 10 stocks, and then hopefully this will beat the S&P 500. That's your ultimate goal. So some of you might look at active investing and think that it will require much more work than passive investing. I think relatively speaking, yes it does. It takes much more work, but when compared to trading, I think trading requires you to sit in front of the monitor to basically monitor candlestick patterns and to identify a sort of trading style and trading framework that you need to follow. While active investing, on the other hand, requires you to follow the fundamentals of the company much more closely rather than look at price action, even though some people like to marry the two together. So specifically for active investing, I can broadly categorize them into four main umbrellas. First is value, second is dividend, third is growth, and fourth is factor. So value investing, I think, is the most famous out of all the different investing philosophy because you have many people like Warren Buffett, Charlie Munger. Those are your goats of investing, and they have created sizable amount of returns. They delivered crazy amount of shareholder value over the last 50 years or so. So I think for value investing specifically, there are also two specific arms. First, you have your deep value. Some of you might know it as cigar butt investing, where you buy very, very cheap companies when the PB ratio, price to book, less than 1, PE ratio of probably less than 10, and you hope that there's some sort of recovery. So this was how Warren Buffett initially started his own investment journey. However, the second umbrella is actually called contemporary value investing. So contemporary, as it suggests, is a new way of investing where Charlie Munger influenced Warren Buffett to think of investing not solely just from a valuation perspective, you also have to look into the quality of the company. And a saying from the recent contemporary value investing arena is that you rather want to buy a wonderful business at a fair price rather than buying a fair business at a wonderful price. Now, moving on to dividend investing, simply put, it's more for a retiree lifestyle where people focus much more on cash flow and income. So most of these dividend stocks comprises of companies like REITs, real estate investment trusts, and your dividend warriors or your dividend aristocrats that are your long-paying dividend players like Coca-Cola, Procter & Gamble, those companies that have been here for a great amount of time. You know that they're not going to go anywhere, but they don't have much growth ahead. And why investors are attracted to dividend investing is really this idea of passive income. And that's basically how they sell the idea to dividend investors. Now, moving on to growth investing, I think there are also two specific types. So there's one that is GARP, which is growth at reasonable price, and I would call it the typical growth investing. So the typical growth investing, you have many companies that are in this sort of page, companies like Tesla, because growth investing really focus on the long tailwind of the company, where you look at it from an opportunistic point of view. There's a huge total addressable market. I think AI is also a recent wave. People are willing to shell out a lot of money, regardless of the valuations that they're trading at. So in a typical growth investor, valuation is not really key. They focus much more in terms of the fundamentals of the business, the trajectory of the business, and the potential of the business. So that's typical growth investing. But for GARP, growth at reasonable price, investors tend to weigh the pros and cons. And since it's a spectrum, they want growth, but they don't need too much growth. They want value, but they don't need too much value. So I guess it's essentially a hybrid between growth and value investing. Then that's how you get this idea of GARP investing. And last but not least, you have the factor investing, where there's actually a body of research and literature behind how certain portfolios are created based on the market cap of the company itself. Small cap tend to outperform large caps. Other factors like momentum, and even factors like ESG. So I think these are just different considerations when looking at individual companies and doing the company analysis on how you're going to curate the 8 to 10 companies in your portfolio to essentially beat the S&P 500. So I hope this video provided you with a very simple framework into understanding the different investing philosophies and how you look at investing in today's market. So there is no right or wrong way to approach investing, but there is only one that is suitable for you. So I hope that this is a start of something exciting for your own personal investment journey. And for those of you who are interested, do check out the links below, where Piranha Profits offer a myriad of different courses, where Adam Khoo specifically focus on value plus momentum, Elson specifically focus on the trading side of the house using price action manipulation, while Bang, on the other hand, focuses on harnessing the power of options. So with that, remember to smash that cute little like button. This is CK from Piranha Profits signing off. Till next time, keep winning.